The candlestick signals make analyzing a trend very simple. After the left-right combo failure of the Dow that started the downtrend, that kind of obviously showed the 200-day moving average was going to act as support. Any buying from there had the prospects of a reversal or a bounce back up to the T-line. Note that on Friday, the Dow did a bearish Harami doji right at the T-line. This made analyzing whether this was a bounce or a reversal very simple. The price was probably going to move, or the trend was usually going to move in the direction of how they opened after a doji. The fact that they opened it lower and started trading lower was a good indication the T-line was going to continue to act as resistance. The next likely target is probably back down here to the 200. Then you have to watch again to see what it does at that level. The same scenario can be applied to the NASDAQ. Good strong reversal, left-right combo, bullish engulfing, gap up, but then on Friday with the bearish Harami right at the 50-day moving average and closing slightly below the T-line, it was very important to see how things opened today. Obviously, a positive open would have told us they were trading higher after a doji type day. The doji rule told us it was going to move in the direction of how they opened after a doji, which was, in this case, a lower open, pretty much indicating they had failed here at the T-line. This is possibly a blue ice failure, where they fell through the ice, the 50-day moving average in this case. They came up to find the hole they fell through. They couldn't find it. They drowned. Where's the next target? The bottom of the pond. Today's recommendation on AMAG, A-M-A-G, was based on a very simple analysis that when you come out of a fry pan bottom, you might see some whipsawing, but usually it's going to break out to the upside. The fact that they did a belt hold type signal, came back up through the T-line and the 50, and continued this trajectory, and we were sitting basically right here at the breakout level. The positive trading today was a good indication that your next likely target was the 200-day moving average. Once again, note how the strength of a pattern disregards what is occurring in the overall market because of the strength of the buildup of investor sentiment in that pattern. Note how the bearish left-right combo up here kind of told us that the strength of this possible uptrend was over. Start looking for a downtrend, mostly confirmed right here. This is where we applied the short position, and then notice what it didn't do after that. They couldn't close it back up above the T-line. Very simple trade analysis. If you see a candlestick sell signal and a close below the T-line, you can stay short until you see a buy signal and a close back up above the T-line, or if you start moving too far away from the T-line, start watching for a reversal signal. But notice the advantage of being short in this position, knowing that as long as it didn't close above the T-line, you were in the right direction. And utilizing the information built into a bullish left-right combo. A doji followed by a bullish engulfing signal and closing above the T-line told us there was a high probability the downtrending resistance of the T-line was now over. Start looking for an uptrend. Once again, note the relevancy of what today's trading indicated when the market was off 300 plus points. Essentially, utilizing the candlestick signals tell you exactly what's happening in investor sentiment, which also includes buying today. Also had the knowledge that the market was selling off, yet they were still buying based upon the signal that we saw a couple of days ago. That'll be it. We'll see you in the chat rooms.